Hey guys, welcome to the Southside Blueprint with the Southside Group Real Estate. I'm here today, Aaron Kraling, with Justin TD, one of our real estate agents, and Emily Johnson from Waterstone Mortgage. Thanks for being here today, guys.
Thanks for having us.
Of course, happy to be here. So, Emily Johnson, Waterstone Mortgage, one of our lenders, one of the lenders we like using here. Starting off with something simple, the loan types. Not everybody may be familiar with all the different loan types, so if you could dive into those a little bit, give a brief overview of those.
Yeah, so there's 4 main loan types, and we kind of do a process of elimination. So the biggest one most people know about is a VA loan. Well, you can only use a VA loan if you are a veteran or a surviving spouse of a veteran. So if you're not that, we're going to knock that one out.
No kid can't do it? A veteran kid?
No,
Okay.
nothing like that. You have to either be a veteran or surviving spouse of a deceased veteran. Next one is going to be a USDA loan. So USDA loans are for more rural areas, so it's very popular here in the Tri-County area. So if you're purchasing in one of the non-eligible areas, that one's out as well. The other 2 are FHA and conventional. FHA historically is for people who have lower credit scores. I'd say about like a 720 or less. And the reason for that is the rates are more favorable for the lower credit scores, and it's a set mortgage insurance amount. Versus conventional, the mortgage insurance amount varies depending on what your credit score is. So to help the client save money, we usually go the FHA route. Last loan type is conventional. So conventional is like the Cadillac of loans because you can do so many different things. You can use a conventional loan to buy a primary residence, a second home, or an investment property. Down payments are very flexible with conventional. If you're a first-time home buyer, the minimum's 3%. If you're a repeat buyer, it's 5%, and then you have the option to put 20% down or whatever. Another thing you can do with the conventional loan is, say you own a house in Solomons, you're looking to buy a house in North Beach, but you want to move into the house in North Beach first before you sell the house in Solomons. So you get in your North Beach house, you sell Solomons, and you net $250,000. Okay, well, I have $250,000. What am I going to do with this? You can then apply that to your balance of the mortgage in the North Beach house. That's called mortgage recasting. So you go to the servicer, you say, I want to apply this balance to my loan. Can you update the monthly payment based on that recast? So that's a nice option with a conventional loan.
Is there a benefit? You said they could put down 3%, 5%, 20%. Other than the monthly payment, is there any other benefit to paying more?
Yeah, so your mortgage insurance varies depending on what the down payment is. So that's always a nice option. And then sometimes the rates will change depending on the down payment. Not always. It's kind of a case by case. So,
Gotcha.
yeah.
I do think it's an interesting fact that you brought up about conventional loans because previously what I used to think and what I think a lot of people think is a conventional loan is 20% down. When I went through my home purchase, we got a conventional with 5% down, and that was the first time I experienced that. So if you want to talk a little bit more about that. So we don't need 20% down for conventional?
Yeah. Listen, this isn't your grandpa's loan anymore.
Yeah.
Okay, so that is like such an old historic myth is that you have to put 20% down. And back then, 20% was nothing back then because the house prices were so much lower versus now, you're looking at $350 minimum, I feel like, for a purchase price. People don't have 20% anymore. Another thing behind that is people think you have to put 20% down in order to eliminate the mortgage insurance. And, you don't want to pay mortgage insurance. You don't want to pay that. Well, the cost of 20% down is far greater than the cost of buying out of mortgage insurance. So mortgage insurance, you have 3 different options. Am I getting off track here?
No, you're good.
Okay.
You're good.
Mortgage insurance, you have a couple different options. So you can pay for it per month or you can pay it upfront. Paying it upfront means you're paying it in your closing cost versus paying it per month. So we'll look at the savings. Okay. If it only costs you $6,000 to buy out of it when you purchase your house versus paying, let's say, $90 per month, which one makes more sense? Because you're going to be paying $90 for how long? Quite a while versus
Right.
if you pay it up front. So just a myth. You don't have to have 20%. Mortgage insurance is very affordable these days, and we have a couple options to get around it.
As the house price increases, with appreciation, does that play into the amount you owe being 20% and the mortgage insurance disappearing, or is it just based on the loan?
So it is based on the appraised value of when you purchased the house.
So it doesn't matter if it appreciates?
No.
Okay.
would you be able to get it reappreciated to get that PMI taken off? Say you did, the market was crazy and your house appreciated $100,000 and you think you have 20% equity. Would you be able to get it
So most mortgage companies will only validate that if you've done any improvements to the home and you can prove that the improvements that you've done have factored into your appreciation.
Painted a wall. Sweet.
Redone a kitchen, redid a bathroom,
I don't think that counts.
Finished your basement or whatever. It can't be based on like the neighborhood appreciation, unfortunately. Yeah.
Gotcha. And talking about VA loans, so something I've heard with people eligible for VA loans, they think you can only do a VA loan once in your life. Now, is that true?
No, that is not true. And you can have multiple VA loans at one time. So actually, I just did a refinance for somebody. They have a home in Colorado that they have their VA loan on. That was the first home that they purchased. They then have been stationed here in Maryland. So they rent out the Colorado house and then they purchase their Maryland house also using their VA loan. So they had plenty of entitlement to be able to carry both properties. Now, go ahead.
I was going to say, what dictates the cap on that?
So it is based off of the max loan amount for the area that you're purchasing, and then the entitlement that you have vested in your different properties. So there's a calculation that we as loan officers do to ensure that you have enough entitlement to cover both homes, or multiple homes if you have many of them. But if you what's the word I want to say? If you go over the entitlement amount that you are allowed to receive, then you have to put a down payment. So it doesn't mean you can't
cover the difference.
Yeah, it doesn't mean you can't use your VA loan. You just have to have a down payment to cover the difference. But what I was about to say is some people think like you can only use it once. And the reason for that is as a VA user or VA buyer, there's something that's called a funding fee. So if you are 10% or more disabled, you do not have to pay that funding fee. You are exempt from it. However, if you're not, you have to pay that funding fee. And the funding fee changes depending on how many times you use your VA loan. So as a first-time home buyer or first-time user, it's 2.15%. But if you're a subsequent user, meaning you're using it for the second, third, fourth time, you have to pay 3.30%.
That's rolled into closing, or?
So that can be rolled into the loan amount, or it can be added on to your closing cost.
Gotcha.
So that's, I think, a lot that people think that you can only use it once.
Right. Yes. No, I do think that explains it pretty well. And I didn't, even knowing that you can hold two concurrently, I think is news for a lot of people.
Yeah.
All right. So with any of the loan types, let's say I just went I just got pre-approved and I'm trying to buy a house. What are some big no's that I shouldn't be doing by the time from when I get pre-qualified to the time I close on a house?
Ferrari.
Do not buy a Ferrari. Do not buy anything. So try to keep everything current from when you got pre-approved. So don't run up any credit cards. Don't get any new loans. Do not give anyone your social security number to pull credit or do anything like that. Try not to move any money around. So if your money is currently, you've got money in, let's say a 401k, and then you have money in a savings account, keep it there. If you plan on moving anything around, you plan on withdrawing, just consult with your loan officer first to make sure it makes sense. And the reason we say that is it's a paper trail nightmare. We have to get documentation from this account to this account, and it can just be a lot. Also, do not make any large deposits, anything that is suspicious.
What's considered large?
I would say like over $1,000. Don't, if you have money on under your mattress, maybe keep it there. Don't try to put it in your savings account because that's a little sus. That's going to be the biggest thing. And then do not switch jobs. If you do have to switch jobs, just talk to me first, okay? Let's figure out, are you going from a W-2 job to another W-2 job, making the same amount of money? Okay, great, no problem. But if you're going from a W-2 job to a commission job, that's a no-go. We can't move forward with the pre-qualification. So what we would hate to happen is you find a house that you love, you go to put in an offer in, you call me to say, hey, I want to put an offer in. I start asking questions and come to find out you can't move forward with that house anymore because you've gotten a new car loan and you no longer qualify, or you changed your pay structure, things like that.
Yeah, I got a lady that we got pre-qualified, and she called me the other day and said, Aaron, I think I might have messed up. I got a new credit card.
No.
Yeah, so we're dealing with that right now. So what you're saying is definitely, I've seen it firsthand.
Yeah.
Now, with the lenders keeping an eye on the large deposits, you said over $1,000 starts getting into the area of, you guys going to notice it. How does that work if somebody's looking, their mother-in-law, mother, whoever, is going to give them gift funds? So how does that process look?
Yeah, very easy. And there is no limit on the amount of gift that you can receive from a family member. So if grandma wants to give you $25,000, fantastic. There's just a gift letter that has to be completed, and then we just have to track the deposit. That's all. So if you say, hey, grandma's giving me $25,000, it will be deposited on Tuesday. Okay, no problem. I know to look out for it, and I'll make a note for it.
What's considered a family member?
So it can be parents, grandparents, siblings, I believe, and uncles.
It's like no third cousins.
No estranged cousins, nothing like that. Yeah.
Fair enough.
Yeah.
Okay, so they do have to be within a certain range.
Yeah, it can't be like your friend just giving you money. It has to be an actual family member.
No brother from a different mother.
No.
Okay.
So another thing not to do when you have been pre-approved, these are things that we're seeing a lot, is a lot of these buy now, pay later accounts.
Like Affirm and Klarna.
Exactly. That is becoming a real headache. And the reason for that is if we see any of those on your bank statements, we now have to include that in your debt to income ratio. And it actually came out that these buy now, pay later accounts are actually going to start affecting your credit as well. So really think before you get one of those accounts, because it's going to hurt you in the long run.
But I wanted to pay 50 cents a month for 20 years.
Yeah, not a good idea.
Yeah, don't finance your DoorDash.
Literally.
Just drive and get it.
Or your Instacart. Like I saw someone finance groceries, and I was like, are you kidding me right now? She
funny.
had money, but she financed her groceries.
Right. Yep. No. So right now, there's a lot going on with the rates. Been a lot of movement. And, from what we've seen in the past couple of years, the 2020 COVID lows, rates are a little higher than then. And that's a lot of what I've heard is buyers are waiting for the rates to go down, so to speak. And so they're putting their home search on pause or putting purchasing on pause until those rates go down. But what we've been seeing is prices continue to go up. So I'd just like to get, what's your opinion on buyers waiting for rates to go down and not taking that step now?
Listen, I just wish everyone could get rid of what rates were doing during COVID, because that is never going to happen again. And historically, we're right around where we were prior to COVID. This is normal interest rate pricing. So it's not anything that's, abnormal versus last year when we were almost at 8%. That was a little bit abnormal. Now we're in the low 6s, high 5s. So that's not a bad place to be. But keep in mind, the longer that you wait because you're trying to time the market, homes are appreciating every year. So the house is going to get more expensive, but the interest rate might get lower. However, that increase in cost is going to offset that lower, interest rate. So why wait? And if you're sitting around waiting for the rates to drop, how many other people are also sitting around waiting for the rates to drop? So the competition is going to get, the market's going to get more saturated with more competition, which is just going to keep driving prices up and up and up. So it's better to time the market, when there aren't as many people waiting around versus when everybody else is trying to buy a house.
Yeah, and we've seen it year after year. Whenever the rates drop, the prices go up. So it's kind of equilibrium that you're fighting with anyway.
Mm-hmm. Yeah, exactly.
Yeah, no, I think it was just the COVID time set an unrealistic expectation for a lot of people. But like you said, when you look back historically, a 6% interest rate is pretty normal.
Yeah.
Yeah, my mom and dad talk about theirs. It was like 12.9 back in the 80s.
I've heard of that,
Mm-hmm.
yeah.
Yeah, but how much was the house back then, too?
Yeah, 88,000.
So, exactly.
That's what cars cost nowadays.
Right.
So, it's like, but no, that's awesome, Emily. And so another thing I'd like to touch on is when you get to the point of placing the offer. I think a lot of people think that whether your offer is strong or weaker comes down exclusively to the price. But a lot of the times there's other factors such as the terms. Another thing that can strengthen your offer is, working with a trusted lender. Mm-hmm. So would you like to talk on that a little bit?
Yeah, definitely. When putting an offer in, a lot of people, like you said, just think about price and then seller concessions. But there's so many other things that you can offer to, stand out from the rest of the people. One thing I always think about is, okay, what is the seller doing right now? What is their current situation? Are they selling this house to then move into another house? Do they have little kids? Because that can be a lot, packing up one house and then moving into your other house. So why not offer like a free rent back? Like, hey, we're going to give you an extra week or an extra 2 weeks after closing to get your affairs in order and get out of the house. That could be like a huge breath of air for the seller who's like so stressed about moving from one house and going into another one. So that's an option. If you have the funds, you can offer to pay 100% recordation taxes with the county. That could...
It's normally 50-50, right?
Yep, yeah. Exactly. Normally 50-50. So that can really help the seller too if they're really pinching pennies. So that's an option, as well as closing date. Like if you're a first-time home buyer and you're living with mom and dad and you're not in a huge rush to get out, but you can tell that the seller needs a little bit longer to get their affairs in order and you don't want to do the rent back, maybe offer a 45-day closing. Or if your lender is able to meet a quicker closing and you can see that the house is vacant, and let's say the sellers have already moved down to North Carolina, you can say, hey, my lender's got this lock and loaded. We're good to go. Let's close in 2 weeks so you can move on to your beach house in North Carolina. So there's a couple different things.
So we had one in Lexington Park not too long ago, and the lady, she was looking for a new home, did not know where she wanted to live or anything. So she ended up selling her home lower than she probably should have, but it had a 6-month potential rent back. Okay. So just that option made her be able to get rid of it, and somebody else got a really good deal because they were willing to deal with that stipulation.
Yeah, definitely.
Yeah, alrighty. Well, that was a lot of what I had. Did you have anything to add, Aaron?
Not really. So we've dealt with a lot of lenders. Emily's definitely one of our favorites. I was going to say I'm dealing with a lender right now, and one of the things that she does, and I was going to ask, is this something you do? She reached out to my seller, and she basically told about the qualifications of my buyer and said, they're really qualified, and come to find out that's the only reason we got this deal. So can you speak a little bit on that?
Yeah, and that reminds me, that was like the second part of your question that I missed, but yeah, it's all about relationships. So using local lenders versus someone online.
Rocket Mortgage.
Yeah, exactly. Local lenders like myself, I really get out in the community. I try to get to know people. I'm very involved in the Southern Maryland Association of Realtors, so it's a great opportunity to get your face out there, get to know other agents in the area. So I actually had an offer that went out last month, and I knew the listing agent from the association that I'm a part of. So I called her, hey, how's it going? Like, how's your family? It's great to chat with you. I have an offer coming out, to your sellers. Let me know if they have any questions. So having that local trust where someone knows other people in the community can really help, make your offer stand out from others. But yeah, we like to call the listing agents, tell them a little bit about the financial stability of the client's buyer profile. So, hey, they have great credit. This is their debt to income ratio. Their income's fantastic, all these different things, just to make them and the seller feel more at ease when accepting an offer, because it's a big thing.
Yeah, good old boys club.
You guys have asked me a lot of questions, so I feel like it's my turn to ask you guys questions. But what makes you feel confident with the lender that you were referring? What are some of the things you guys look for that give you a peace of mind?
Yeah, you've hinted on it a little bit. It's that personal conversations, reaching out to the clients, actually talking to them, letting them know what's going on and keep them in the loop. I've had plenty of clients that I've had other lenders with that they say, I haven't heard from the lender in months, and they said, call me when your credit's better. And, that's kind of something people don't want to hear. People want to feel respected and appreciated. So I think that's one of the big things on my side.
Yeah, I think communication is a huge part of it because, when we're working with a client and the lender themselves actually reaches out to them, I feel like they have a greater level of trust with us, and with our the people we're referencing is reaching out to them, and it's just a positive experience overall for them. Yeah. So I think the communication is a big part of it.
Okay, cool. What would you tell a new real estate agent to, what would be a red flag when picking a loan officer to work with and refer?
That's a good question.
Yeah.
I think so. I guess one, if they try to pigeonhole you into any certain programs, they should be asking questions, figuring out, what is actually best for your client. So putting the client first. I guess that would be the main thing I can think of. Anything else?
Yeah, probably just if they're not being super transparent with you, I feel that the lender should be able to answer the questions you have, and not just on a knowledge standpoint of, understanding standpoint, making sure that the client understands the whole process, because it's a big purchase for them and they want to make sure they understand the different pieces. And also, at the end of the day, that they're getting the best deal for themselves as well.
Yeah, and I think to top on that, expectations. I think the expectations should be laid out. Say, your credit's not where it needs to be, but if you do this, this, and this, we can get you there. Now, if you don't do this, this is what's going to happen. So I think expectations are like a huge part of that. Somebody needs to know what's going to happen if they do certain things and what to expect.
Mm-hmm. Yeah, for sure. And from your guys' personal experience, when you refer somebody over to get pre-approved, what is a rough timeline for them to expect to hear back with numbers if everything looks good and they get their documents in?
Well, if everything's perfect, they could be the same day. It really could be. But in my experience, everything's not perfect, to say the least. So from everything being perfect, same day to the standard experience, 3 to 5 days if they've got all their ducks in a row. If not, then, you're telling them do this, get your credit here. And that could take 30, 60, 90 days. Had a lady recently who was at a 530 credit score, and she needed to get that up a little bit. So that was in June, and now we have her, pre-approved and ready to go. And that was June, July, August, September, 4 months ago. So the timeline's really variable depending on where they are in their journey. But, if everything's ready to go, within a week you should be pre-approved.
Yeah, definitely.
I think the key is when they get the documents in, because that seems to be one of the parts that kind of holds it up. So from my experience, once those documents have been submitted, it's a very quick turnaround, like 24 hours to that. From my experience, has always been that it's just getting those documents submitted, but I would say a couple days.
Do you guys think it's beneficial to tag team?
1,000%.
Yeah.
For sure.
If I follow up, hey, where are your documents? And then I say, Aaron, they still haven't got me their documents. That's great for you to tag in as well.
And then group text, and they're like, oh, no, they both see this.
Right.
I can't hide from them.
Yeah.
Yeah. Okay, awesome. Well, thanks for taking my questions.
Of course. Thank you.
Absolutely. So thanks, guys, for tuning in. It's the Southside Group with Waterstone Mortgage hold on, man. The Southside Blueprint. All right, well, thanks for tuning in, guys. This is the Southside Blueprint. Have Justin Teedy with Southside Group Real Estate, myself, Aaron Kraling, also with Southside Group Real Estate, and Emily Johnson with Waterstone Mortgage. In the links below, you can go ahead and set up a 15-minute conversation with myself, Justin, or Emily to go over your real estate or lending needs, and we'll see you next time.